For 158 years, this company had survived the Civil War, the Great Depression, 2 world wars, and every financial panic in between. By 2008, it was the 4th largest investment bank in the United States, managing over $600 billion in assets. It took less than a single weekend for all of it to end. On September 15, 2008, Lehman Brothers filed the largest bankruptcy in American history and triggered what would become the worst global financial crisis in nearly a century. This is the story of how a 158-year-old institution that had survived everything history could throw at it was destroyed by a risk it had taken on itself. To understand how Lehman Brothers collapsed in a single weekend, you first have to understand just how long it had already lasted. Lehman Brothers was founded in 1850 in Montgomery, Alabama, by 3 brothers, Henry, Emanuel, and Mayer Lehman, as a general store that gradually evolved into a cotton trading business. Over the following century and a half, the firm transformed itself again and again into a commodities brokerage, then a full investment bank, surviving the Civil War, multiple 19th century financial panics, the Great Depression, and 2 world wars along the way. By the 2000s, Lehman Brothers was one of the most respected names on Wall Street, a firm whose sheer institutional longevity had become part of its brand. Under CEO Richard Fuld, who had led the company for over a decade, Lehman was aggressively pursuing one of the fastest-growing, most lucrative businesses in American finance: mortgage lending and the securities built on top of it. Through the mid-2000s, the U.S. housing market was booming, and Wall Street had found an enormously profitable way to participate in that boom beyond simply lending money to homebuyers directly. Banks bundled thousands of individual mortgages together into complex securities, mortgage-backed securities, which could then be sold to investors around the world, generating substantial fees at every stage of the process. Lehman Brothers pushed further into this business than almost any other firm on Wall Street, becoming one of the largest underwriters of mortgage-backed securities in the world. The strategy generated extraordinary profits during the housing boom. Lehman's revenue and stock price climbed steadily through the mid-2000s, and the firm was widely praised for its aggressive, high-conviction bets on the continued strength of the American housing market. To maximize returns on this strategy, Lehman operated with extremely high leverage, reportedly holding roughly $30 in borrowed money for every $1 of the firm's own capital. This meant that even a modest decline in the value of Lehman's mortgage-related assets could wipe out a significant share of the firm's actual equity, since so little of what Lehman held was truly its own money to begin with. For years, as housing prices kept climbing, this leverage simply amplified Lehman's profits. Nobody inside the firm was treating it as a serious vulnerability, because the underlying housing market hadn't given them a reason to. That underlying assumption that U.S. housing prices would keep climbing, or at worst plateau, was about to prove catastrophically wrong. Beginning in 2007, U.S. housing prices started falling for the first time in decades, and mortgage defaults, particularly among subprime borrowers, began rising sharply. The mortgage-backed securities that Lehman and other Wall Street firms had built their profits on started losing value rapidly, and in many cases nobody could even agree on what those securities were actually worth anymore, since the market for trading them had started to freeze up entirely. Lehman's massive leverage, which had amplified its profits during the boom, now amplified its losses just as severely on the way down. Because Lehman had borrowed so heavily against a relatively small base of its own capital, even a partial decline in the value of its mortgage holdings threatened to wipe out the firm's entire equity cushion. Through late 2007 and into 2008, Lehman reported mounting losses tied to its mortgage exposure, and its stock price began a steep decline as investors grew increasingly worried about the firm's ability to absorb further losses. Here's the irony sitting at the center of this story. the exact same aggressive leverage strategy that had made Lehman one of the most profitable firms on Wall Street during the housing boom, borrowing heavily to maximize returns on mortgage securities, was the very thing that left the firm with almost no capital cushion the moment those same securities turned against it. Through the first half of 2008, Lehman's leadership, including CEO Richard Fuld, publicly maintained that the firm's problems were manageable and, at times, blamed short sellers for driving down the stock price, rather than acknowledging the depth of Lehman's underlying exposure. Behind the scenes, the firm scrambled to raise emergency capital and find a buyer, holding talks with the Korea Development Bank and later with Bank of America and British bank Barclays. But each potential deal fell through. In Barclays' case, reportedly due to regulatory hurdles that couldn't be cleared over that final weekend. Crucially, unlike Bear Stearns, a smaller Wall Street firm that had faced a similar crisis just 6 months earlier and been rescued through a Federal Reserve-backed acquisition by J.P. Morgan Chase. The U.S. Treasury and Federal Reserve, led by Treasury Secretary Hank Paulson, ultimately declined to provide a similar backstop for Lehman. With no buyer and no government support materializing over the weekend of September 13th to 14th, 2008, Lehman Brothers had run out of options. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. With over $600 billion in assets, the largest bankruptcy filing in American history at the time, the collapse sent immediate shockwaves through global financial markets. Credit markets that banks relied on for daily short-term funding froze almost overnight as institutions across the world suddenly refused to lend to each other for fear that the next firm might collapse just as suddenly as Lehman had. Stock markets around the world plunged in the following days, and the crisis rapidly spread well beyond Lehman itself, threatening the stability of the broader financial system. Lehman's collapse is widely regarded by economists as the single event that turned a serious but contained financial problem into a full-blown global financial crisis. In the weeks that followed, the U.S. government intervened dramatically to prevent further collapses, including a $700 billion bank bailout program known as TARP, and the crisis ultimately triggered the Great Recession, a period of severe global economic downturn that lasted years. Richard Fuld never led another major financial institution after Lehman's collapse and has largely remained out of the public spotlight since, though he has occasionally spoken publicly defending his decisions during the crisis. Barclays ultimately purchased Lehman's North American investment banking operations out of bankruptcy at a steep discount within days of the collapse, while other pieces of the firm were sold off separately across multiple countries. Lehman Brothers' bankruptcy proceedings, one of the most complex in corporate history, continued for years afterward as administrators worked to recover value for creditors from the firm's remaining assets. Lehman Brothers' story isn't really about mortgages. It's about what happens when a strategy of borrowing heavily to amplify returns works so well for so long that an entire firm stops treating its own fragility as a real risk, until the one assumption the whole strategy depended on turns out to be wrong, and there's no cushion left to absorb it. It's a pattern that shows up again and again in business and financial history. The same leverage that turns modest gains into extraordinary profits during good times turns modest losses into existential threats during bad ones. And a 158-year institutional track record doesn't protect a firm from a mistake made in its final decade. If you'd like to understand the hidden forces shaping our global economy, help us by subscribing to our channel.